Welcome back to Talk Tickers. This is the place where we strip away all the corporate fluff, we ignore the PR spin, and we get straight to the numbers that actually matter.
That's right. If you're a professional investor, day trader, or just, obsessed with what makes markets tick, you are in the right place.
And today we are popping the hood on a regional bank story that is, well, it's a bit of a head-scratcher, and I don't say that lightly.
It certainly is. We are looking at Heritage Financial, ticker HFWA. Specifically, their Q4 2025 earnings call from January 22nd.
And here's the setup. If you just looked at the surface, you'd think the stock would be flying.
Oh, absolutely.
Let's just look at let's call it the crime scene. The earnings hit the wire pre-market. The headline numbers were fantastic.
We'll get to just how good in a second.
The market sees this, and the stock indicates up nearly 7% in the pre-market. It's trading around, what, $26.89? Look like a breakout.
And then the opening bell rings, real money enters the chat, and that rally it evaporated.
Completely. By the close, the stock was essentially flat. It finished up just 0.36% at around $24.91.
So that's our mission today, right? We have to figure out why.
Exactly. Why did the market sell the news after what looked like a massive beat? Is this just buy the rumor, sell the news? Or is there a red flag buried in that transcript?
I think it's a classic case of headline beauty versus, let's call it, structural anxiety. But before we get to the fear, we have to respect the numbers. They were genuinely impressive.
Okay, let's do the result snapshot. GAAP EPS came in at $0.65.
And the street was looking for $0.56. That's a 16% surprise.
In the banking world, a 16% beat is.
Yeah.
That's huge. Analysts usually have these models dialed into the penny.
And it wasn't just accounting tricks. Revenue was solid. Came in at $66.35 million, beating the top end of the consensus range.
Net income stood at $22.2 million with a return on average assets, an ROAA of 1.27%. Those are very healthy sort of Goldilocks numbers.
Not too hot, not too cold. And they declared a dividend of $0.24 a share.
So you've got a profitable bank, it's beating expectations, it's growing revenue, and it's paying you to wait. Management sounded bullish.
Yeah, they were talking all about margin expansion and this merger that's literally days away.
So on paper, this should have been a slam dunk. Why did investors hit the sell button?
To understand that, you have to look under the hood at the engine of the bank. And right now, Heritage is pulling off something that theoretically just shouldn't be happening.
Let's talk about that. You're calling it the margin miracle.
Miracle might be a strong word, but it's close.
Okay, let's set the scene. The Fed cut rates 3 times in the last 4 months of 2025. Conventionally, when rates go down, bank margins get squeezed.
That's banking 101. The yield on your loans drops faster than you can lower what you pay depositors.
But Heritage broke that rule. They reported a net interest margin, a NIM of 3.72%.
And that's actually up 8 basis points from last quarter.
Wait, hold on. So rates are going down, but their margin, their profitability is going up. How are they pulling that off?
It's 2 things, really. Deposit beta and what I'd call loan churn.
Okay, break down deposit beta for us.
It's just a fancy term for how fast they adjust deposit rates. And Heritage is cutting the interest they pay out really fast. The cost of their interest-bearing demand deposits dropped to 1.83% from 1.89%.
So they're quick to cut what they pay you, but slow to cut what they charge you.
Sort of, yeah. But the real magic is on the other side, on the loan side. Their loan yields actually ticked up 1 basis point to 5.54%.
While the Fed is cutting. I mean, that sounds completely counterintuitive.
It is, but it's about the vintage of the loans. Think about it. They still have old, low-rate loans from 3-4 years ago on the books.
Right.
Those are getting paid off. And the new loans they're writing, especially in commercial, are coming in at around 6.56%.
Ah, I see. So they're replacing a 4% loan from 2022 with a 6.5% loan today. Even if overall rates are falling, their internal rate is rising because of that churn.
You've got it. It's like replacing the slowest runner on your relay team with a sprinter. Your average team speed goes up, even if the track is muddy.
And management was pretty bold on this, right? They're guiding for a NIM near 4%.
Which is a huge statement. If they hit 4% IM in a cutting environment, their profitability is just going to explode compared to their peers.
But it's not the only engine here. We have to talk about the big acquisition. The one hanging over the stock.
The Olympic Bancorp acquisition. This is the move that defines their 2026.
And we finally got a clear timeline. Approvals are in. Closing is expected around January 31st.
So, yeah, days away. System conversion is targeted for September.
Now, usually when you hear merger, you think synergies, which just means firing people. But this one feels different.
It is different. This is an arbitrage play.
Unpack that. Arbitrage in this context.
They're buying cheap money. Simple as that. Olympic Bancorp has a very low cost of deposits, around 1.02%.
And Heritage's legacy cost is much higher.
Exactly. So Heritage is buying this giant pool of extremely cheap funding.
So they take Olympic's 1% money and turn around and lend it out at their 6.5% rates.
That's the math. It's pure spread expansion. And that's why that near 4% IM target is actually realistic. They're just blending down their cost of funds.
Okay, but you can have all the cheap money in the world, but if you don't have anyone to lend it to, and their loan growth in 2025 was, let's just call it flat.
It was flat. They had heavy payoffs in Q4. Basically, customers were paying back loans faster than they could write new ones.
So what's the outlook there?
Guidance for 2026 is a return to historical levels. So, low single digits in Q1 and then accelerating through the year. The pipeline is rebuilding. It ended Q4 at $468 million.
Okay, so the engine is idling, but they're getting ready to hit the gas. But let's go back to the mystery. Margins expanding, a great merger, pipeline is full. Why did the stock fade?
This is where we have to look at the bear case. Credit quality. It wasn't perfect.
No. And in this market, not perfect gets punished hard.
There were two metrics that jumped out. First, non-accruals.
Right, non-accruals loans where the borrower has just stopped paying ticked up from 0.37% to 0.44% of total loans.
And that was driven by 3 non-owner occupied commercial real estate loans. CRE.
CRE is already a 4-letter word in banking right now. Any tick up there makes people sweat.
It's a warning shot. But the bigger red flag, the one that probably had the algos hitting sell, was the substandard loans category.
Yeah, that number was startling. Substandard loans jumped 24% in one quarter.
A 24% jump. That's a massive move for a 90-day period.
So what happened there? What did they say?
Well, if you dig into the transcript, the chief credit officer said it was mostly driven by 2 C&I relationships, commercial and industrial, that got downgraded, totaled about $30 million.
Did they give a reason? Was it tariffs, a specific industry, any color at all?
And that's the friction point. Management claimed there was no correlation. They specifically said it wasn't tariffs, wasn't industry specific. They called it idiosyncratic timing.
Idiosyncratic is banker speak for. We had bad luck with these 2 specific guys, but do we believe that?
That's the risk, right? It feels a bit dismissive. To be fair, though, their actual losses, their net charge-offs, were incredibly low. Just $481,000 for the whole quarter.
So the loans are graded worse, but they haven't actually lost a lot of money on them.
Yeah.
Yet.
But if you're an investor looking at 2026 and you see substandard loans spike 24%, you pause. You have to. You wonder if this is the start of a trend.
Because if that $30 million goes to zero, that nice EPS beat we just celebrated gets wiped out pretty quick.
Exactly. And that uncertainty is what capped the rally. Investors are saying, great quarter, now show me that credit isn't about to blow up. It's a show me market.
Let's touch on efficiency quickly. Because while credit's a little messy, they seem to be running a tight ship on the expense side.
They really are. They reaffirmed non-interest expense guidance at $41 to $42 million a quarter. And what's interesting is that their headcount, their FTEs, actually decreased.
Even while they're prepping for this huge merger, usually expenses balloon before a deal closes.
It suggests they're stretching the current team pretty thin. But the important thing is the operating leverage. When those systems convert in September, the synergy savings are going to drop straight to the bottom line because they didn't bloat the cost base now.
Let's zoom out a bit. Investor context. They talked about the $10 billion asset threshold. Why is that number so important?
It's a magic number in U.S. banking. Once you cross it, regulation gets a lot more expensive. Specifically, the Durbin Amendment kicks in.
Right, the Durbin Amendment. Remind us what that does.
It basically caps the interchange fees a bank can charge on debit card swipes. It's a direct hit to a revenue stream. Plus, compliance costs just soar.
And where's Heritage now?
They're still below it, but with Olympic coming on board, they're getting closer. Management said they're years away from crossing it organically, but they did admit the infrastructure spend is already happening.
So they're paying for the bigger bank infrastructure now, while still being a smaller bank.
Correct. It's a drag on earnings now, but it means they're future-proofed.
So what's the macro read here? What does Heritage tell us about the broader regional bank space?
I think the signal is actually very positive for the sector despite the credit blip. If Heritage can expand its NIM to 4% while the Fed is cutting rates, it suggests the fear of that deposit cliff might be overblown for a lot of regionals.
That is a huge signal. The market has been terrified that rate cuts would just crush these guys.
And Heritage is proving the opposite is possible. The sell-side analysts definitely noticed we saw one price target get raised to $32 right after the print.
But again, the price action on the day just didn't match that optimism.
Show me mode.
Which brings us to my favorite part of the show. We've looked at the data, we've analyzed the fears, and now it is time to put on our hedge fund manager hats.
The obligatory disclaimer time.
Absolutely. This is not financial advice segment.
Yeah.
We are not your advisors. This is purely a thought experiment. Do not actually do this trade.
Yeah.
But if we were pitching this to an investment committee, what's the play?
I'm calling this one the Olympic arbitrage slingshot.
Okay, I love the name. Break it down.
The thesis is simple. The market is pricing in the credit fear from those C&I downgrades, but it is completely ignoring the funding arbitrage from the merger.
So the market sees a boring bank with some loan problems.
And we see a machine that's about to ingest 1% cost of funds.
What's the trade structure?
It's a pairs trade. You go long HFWA, and you go short the regional banking ETF, KRE.
So you're hedging out the sector risk. Why short the ETF? Why not just buy the stock?
Because the average bank in that ETF is going to suffer from rate cuts. Most of them don't have this secret weapon, this Olympic acquisition. You're betting specifically on the spread between Heritage and the average regional bank.
So if the whole sector sells off, your short protects you. If the sector rallies,
Heritage should rally harder. You're betting on outperformance driven by that one unique catalyst.
the cheap deposits,
Yes. Olympic's deposits cost around 1%. The average regional is paying way more. Heritage's DIM is already expanding to 3.72%. When those Olympic deposits merge on Jan 31st and the systems convert in September, their NIM is going to violently decouple from the sector.
so the sector might be stuck at, say, 3.1%, while Heritage slingshots towards 4%.
And a bank with a 4% IM in a low-rate world doesn't trade at a discount. It gets a premium multiple.
So if they hit that target,
If they hit near 4% by the end of 2026, this isn't a $25 stock. The math suggests it's a $35 stock. You are basically buying the dip caused by boring price action on a day they beat EPS by 16%.
and the outrageous kicker is that you're betting that 24% spike in substandard loans is just noise.
That's the risk. If the C&I portfolio really does collapse, the trade blows up. But the reward is capturing that margin expansion that the market just doesn't seem to be pricing in yet.
The Olympic arbitrage slingshot. I like it. Risky, but it's backed by the math.
It's always in the footnotes.
All right, let's wrap this up. Quick recap for everybody.
Headline beat. $65 EPS versus $7.56 consensus. Revenue beat, too.
The NIM expansion is very real. It's already at 3.72% with a target of 4.00%.
The Olympic merger closes in just days, around January 31st.
But the big watch item is credit risk. That substandard loan number spiked. You have to keep an eye on that.
And that's why this stock ultimately faded intraday.
So my final thought for you to chew on is this. The market gave this report a polite little golf clap, up less than 0.5%. But if you look under the hood, the fundamentals suggest this bank is about to become significantly more profitable than its peers. The question is, do you trust management on credit quality enough to ride that margin wave?
It's going to be a fascinating Q1 and Q2. Keep an eye on those post-merger integration costs. That's where the noise will be next quarter.
And we will be here to break it all down when it happens. Thanks for listening to this deep dive. Like, subscribe, leave us a review, and we will catch you on the next earnings print.
See you next time.